right, aloha and welcome to the Own the Outcome podcast. My name is Tyler Deveraux, and today I'm going to do a solo episode, meaning a lot of the times I'll interview different business and thought leaders in the space, but today I'm going to talk about business as a thought leader in the space. I'm the founder and CEO of two eight-figure businesses, and for context at that, less than 1%, I think it's like 0.07% of businesses ever produce more than 10 million in revenue. I have two businesses that do that, and the best year that we had was more than 4 times that number. I say that because the things that I'm about to walk you through are going to help you simplify business in your mind. Business can be, and I even had it buy a business or get into a business can be daunting, but it's not, man. It is daunting if you don't understand the foundational principles of it and how to make it happen. And that's what I'm going to do today. The business that I'm primarily in is the buying and owning and then eventually reselling of apartment buildings. So I bought and sold 17 different businesses, apartments. See, every apartment is ran, valued, operated like a true business. That's where I've learned business, is running, owning, operating these apartment buildings. So I bought and sold 17 of those, meaning I bought, carried out the business plan, and exited those, and all but 2 of those have been profitable. Now, those 2 that were not were some of my biggest learning lessons, and I believe what make me even more qualified to teach and train and help with your business than the other 15 that were massively successful, because you learn a lot from those. But today is going to open your mind on possibility of business and then to simplify that process. Now, I'm going to relate it to the multifamily space, but it applies to any and every business. Like the fundamentals of business all apply here. So whether you're looking at buying apartments or buying other businesses and operating other businesses, today will certainly help you. Now, there are 5 moving parts of any business. That's what I'm going to walk you through. So step 1, you need to find the business or the property, okay? There are 33 million businesses in the U.S., by the way, and 99% of them are small businesses. Over 40% of those are owned by baby boomers. In other words, these are individuals. Keith Cunningham, if you don't know who Keith Cunningham is, I love this dude. He has a great book. It's called The Road Less Stupid. And he says, 40% of these businesses are owned by baby boomers. And he says, in other words, they're old, sick, tired, and dying. And Keith Cunningham fits that mix, which is what makes it so funny when he says it. But it's the reality. These baby boomers who own these businesses, a massive amount of them, the stat that I read is 60% of them, I don't know how they know that though, but 60% of them have no succession plan, progression or succession plan, which means you're either going to buy that business from them or property. They'll lose that business or property, or they'll die running that business or property, which will then go to their kids, and their kids don't want to take it over. So you'll see throughout this, man, you can be the kid that they wish that they had. The one to buy that business, the one who's going to take that property and run it and thrive. And that is how you get what you're looking for. So listen, we are in the middle right now of the biggest wealth transfer in history, not just in our lifetimes, in history. And it's because of the massive amount of wealth that is owned by the baby boomers. In other words, these individuals who own these businesses, properties, who are now looking to get rid of or out of them. And even if those are not for sale, they're for sale. Anything and everything is for sale. You just need to know what their pain point is and how you solve it. So what you really need to know is, what business do you want to buy? So step 1 is find the business, but you need to know what is an attractive business versus one that's not attractive. So I'm going to give you 5 keys of an attractive business, okay? And remember, when your target is clear, success is near. So you need to know what you're looking for. So once again, when I say business, I'm talking about properties and businesses. It's the same thing. Those go back and forth. It's the same exact same things that we're looking for. So number 1 key is there demand? Meaning, do people want to actually live there? Right? An example, I bought a smaller property in Mooresville, North Carolina, and it was a unique unit mix where all of them were 1 bedroom, 1 bath. And so the business, apartment business, okay, I get it. But is there demand for that asset in that market? So what did I need to do? And for that unit mix, so I needed to look at historicals bigger than a year to see, is there demand for that unit mix in that market? So essentially, do people want to live there? Is there demand? And do the trends show that? Number two is the market growing, okay? So is the market a growing market or a dying market? So an example of this, okay, in the business world, think DVDs versus streaming. Streaming, that business is booming and growing. DVDs, not so much. Okay. What about your property though? Are people moving in that area or out of that area? Are businesses coming in to that area or are they moving out of that area? What's happening within your market? Number three is there a separator? That property that you're buying, does it have a separator? See, I do not want to buy a property or a business that doesn't have a separator. Every business that you start, buy, operate should have a separator, or else, man, anybody and everybody can do what you do. Like, for example, in the property space, in the apartment space, I want to know the location. I can change a lot about an apartment, but I can't change the location. So do they have a specific location that's attractive? Is there amenities that the other owners don't have? For example, I bought a 138 unit deal in Columbia, South Carolina, where every single unit had a stackable washer or dryer that they were not charging for. By the way, that will come into step 4 here in a minute, but they weren't charging for it. That was an amenity, a separator that none of my other competition had. Maybe access to the freeway, right? Is it easy access to the freeway? What is the separator of the business or the property? And then number 4, are there value add opportunities? And when I say value add opportunities, it is literally how it sounds. It's ways to add value to the business, grow revenue. What can you do to grow revenue? Like our bread and butter when we're buying an apartment building is, yes, I'm looking at where the income of the revenue is today. I need to know that. But I also need to know where are these gaps that they haven't filled but we can fill? Where are they leaking money that we can then plug those gaps to make that money? So for an example, with the stackable washer or dryer. Stackable washer or dryer, an amenity that my other competitors didn't have, but that owner wasn't charging for the stackable washer or dryer. Okay, so what do? We take that down. Hey, that is a value add opportunity. We can immediately start charging for those washers and dryers. That will increase revenue, and any business is valued by the revenue. The more the revenue, the bigger the demand, and the bigger your margins will be, which come into number 5. Are there healthy margins? Does enough of the income flow to the bottom line? And if it doesn't, it's too risky. And if it's risky, it's an unattractive deal. See, the riskiest type of multifamily deal is what's considered a reposition. And a reposition deal is a deal that is not cash flow positive day one. It's not cash flow positive, meaning you have to calculate your break-even point. At what point, when you put in the work and you do the things, will you become profitable? And if you miscalculate that break-even point, well, there's a great chance you lose that business, that property, which would make it very unattractive. You need to identify those things up front. What does healthy margins mean to you? We teach return metrics and things within our program, but for you, what does healthy margins mean for you? How much of the income needs to flow to the bottom line for it to be attractive? Now, some rules with this, okay? You need to date before you buy. Date before you buy. Meaning, and what I mean by that is look at a lot of deals. I believe one of the biggest mistakes people within our mentorship program make is they don't look at enough deals. They don't look at enough deals. They don't know what is a good or attractive versus unattractive. And related to this, if you were on an island, let's say you grew up on an island, you were by yourself. You had literally never seen anybody else before. You had never seen any other human being before. Then all of a sudden, it's your birthday, and a young lady, if you're a man, or if you're a girl, or whatever your sexual preference is, beyond the point, a person that is of your sexual preference, desire, you get it, comes up in a boat. Okay, well, is that person attractive or are they unattractive? You have no idea because you've never seen another person before. All you know is that it's your birthday and God just sent you a gift, okay? But all of a sudden, you look at a whole bunch of people. You're in Manhattan. You see people every single day, everywhere you look. You're going to know who is and who isn't attractive to you. Once again, based on your rules and what your margins look like. So look at more deals. However many deals you've looked at, you need to look at more to determine what is good, what is bad, which ones are attractive, and which ones you need to leave on the damn boat. Now, how you find them, let people know that you're looking, man. Let people know that you're looking. How often are you talking to brokers? How often are you talking to attorneys? How often are you talking to divorce attorneys, as an example? Like a lot of these baby boomers that own these, or owners, period. Maybe they own it with their spouse. Maybe they're getting divorced. Maybe now they have to offload the business. Maybe they have a business divorce. Maybe they have a partner that they're divorcing, and now they need to split assets and get rid of assets because they want to get rid of the partner that they own that asset with. Attorneys will know those kind of things. But with anything, nobody knows what you're looking to do unless you tell them what you're looking to do. Tell them what you're doing. It is crazy to me how many people are out there trying to find something by themselves without saying or talking about what they're looking to buy or do. And I'm going to give you some context with this, okay? A good friend of ours, I'm going to obviously not talk about names or situations, but a good friend of ours, their daughter went missing. Scary situation. Super scary situation. Their urgency to find her absolutely through the roof. Their urgency to find her absolutely through the roof. So what do you think they did? Do you think that they just kept it to themselves and between the two of them went out looking? Or do you think that they let anybody and everyone that they know? Well, if you're urgent, if you're really decided that you're going to do this business, or in this scenario, find your daughter, you're going to let everyone and anyone know because the word will spread. Let me tell you eventually what happened. My wife had a conversation with a friend randomly, who then told her husband, who was in the police force, who then happened to be in a meeting, who then happened to mention it in that meeting. And then that, right after the meeting, the individual went to a store and lo and behold, there is the daughter that they're looking for. You never know where the gaps are going to be filled or who's going to bring you the opportunity or the connection or what it is you're looking for. You just need to know that you're looking for it and you need to let everyone know that you're looking for it, because what you focus on, you find, or what you focus on and let other people know about, they will find and bring to you. Now, number one, let you know what business you're buying. Number two is you need to know how to determine the value. Now, in the apartment space, you determine the value by the income. In the business space, you also determine the value by a multiple of the income. Same thing, okay? So your net operating income, that is income subtract your expenses, gives you your net operating income. That's going to help you determine the value. You take that net operating income number, and once again, this is the same for whether you're buying an apartment building or whether you're buying a business. You take the NOI, and it's going to be by a multiple of the business, and I'll give you an example of that will help you understand the value. And the multiple is adjusted for growth and risk. Like if there is a business that is growing at a massively rapid pace, you may pay a higher multiple for that business because you see the growth rate that the business is having. Now, same with an apartment building, okay? If you see that the growth is happening exponentially, maybe the cap rate, which is a return metric that we use, that you would be willing to pay is lower than if you're in a stagnant market. But also you already know that if the market is stagnant, not growing, like we said above, you're not going to buy that anyway. But let's be on the point. You need to know what you are willing to pay for that. So it's your NOI divided by your cap rate will give you the value that you're willing to pay. You need to set that up front. Then you need to do due diligence on that. You need to know, is the income, you need to verify, is the income predictable and sustainable? Is it predictable and sustainable? Or is the income coming in from your apartment building, as an example? Do you have tenants that pay every month on time, or do you have a huge chunk of them who pay late and some don't pay at all? Look at the income. How predictable and sustainable is it? Also, what is the growth rate, the trend on the property? Has the income been trending up? Has it been stagnant, or has it been trending down? What is the growth rate? Now, if the income has been trending down, that may not mean that it is a bad business. That may mean it's a bad operator. But you need to determine, is that the case? Why has it been trending down? Maybe those are some ways that you can come in and improve to, once again, make it trend up. But you have to be very careful, which comes to the next one, which is what are the risks? What are the biggest risks on the property? And then more importantly, how will you mitigate those risks? If you're not asking that question with any business you're buying, you're not taking the business serious enough. What are the biggest risks on this? How will you mitigate those? Is there a way to mitigate those, or are you just inheriting those and hoping that you're okay? What are they, and how do you mitigate those? Ask those questions, list those out, talk about those things, get guidance on how you would mitigate those. And then once again, the due diligence on the margins. Is there enough that flows to the bottom line for you to determine, yes, this is the property that I want to buy, or no? It's baffling to me how many people buy businesses, aka and or apartment buildings, with there's no margins, which means you're going to be working for free, and nobody wants to work for free. You do not want to be in business where you work for free. So are the margins there? Once again, determine your value. Now, once you know what you're buying, you know how to value it, then you need to actually buy it. So there's some things that so number 3 is buy the deal. So number 1, find it. Number 2, value it. Number 3, buy it. So things that you need to know. What price are you willing to pay, like I mentioned above? What price? What will also be the terms? Like, what will the terms be? Will it be a cash deal? You're paying cash? Are you going to use seller financing? Are you going to use bank financing? Is it going to be a combination of those? Like, what will it be? Now, there's some rules that I want to give you as well with your offer, and then I'll get more into what the terms will be and how you actually find the cash, the seller finance, what those things look like, okay? But some rules with your offer. 2 dates and then a proposal. 2 dates and then a proposal, meaning a lot of these deals, these apartment deals that you're going to be buying, you're going to be meeting with brokers. And the last thing you want to do is submit an offer to a broker the first conversation that you have with that broker. You want to date the broker and or date the buyer or the seller if you're going to get directly from the seller. So have a couple meetings with them. Ask questions about why they're looking to sell. Ask questions about the property. We have a whole list. In fact, listen, we have an entire list of questions that you can ask the broker or the seller, depending on who you're meeting with, to help you determine, is this something that you would like to buy? So if you would like to know those questions, we put it together for you in a PDF down below. You can click the link. You can get a whole list of the questions that we ask. You're welcome. But make sure that during those meetings, during those dates, you ask those questions. And then you either make an offer or you don't. Proposal. You either make the offer, the proposal, or you don't. But when you make the proposal, the offer, there's going to be even more due diligence before the wedding, before you actually buy it. Once again, before the wedding, there's going to be more due diligence. So, for example, when we buy an apartment building, okay, I know what I want. I find it. I know how to value it. Now I've went in to buy it. I've submitted an offer to buy it. They've agreed to that offer. Now what's going to happen is I'm going to start my due diligence period. And I'm going to check and see, can I verify everything? Is this something for sure that I want to buy, aka marry? Now, another rule, okay? So rule number 1, 2 dates and a proposal. Rule number 2 is you use attorneys, use lawyers to draft your documents. When you're buying any business or any apartment building, use attorneys. When you structure your business, use attorneys. Man, this is absolutely a mistake that I made within my businesses. Is that, listen, we structured the operating agreement. In the beginning, everything was great. So we structured the operating agreement as if everything would continue to be great. And then guess what happened? It didn't continue to be great. And then I was left having to pay and buy out a partner who's just walking away from, the work. That hurts the business. That impacts the business. Make sure that your operating agreements are solid and planning for the worst, hoping for the best, but planning for the worst. And attorneys will help you draft those. Do not try to do that on your own. And then rule number 3, it has to work for the seller too. Listen, if you're truly going to build a business, buy a business, and scale that business, it has to work on both sides. Like, it's not this business where you're going to come in, an apartment building as an example. You don't have to go in and it's not win-lose, okay? It can be win-win. You can structure an offer that is a win-win, which is why rule number one is to have 2 dates and then a proposal. That proposal, that offer, on those 2 dates, you're trying to figure out what does that offer, that proposal need to look like in order for it to be a win-win. Become how you separate yourself from other people who may be trying to buy that apartment building. Become the son or the daughter that person never had. Become the son or the daughter that person never had. Maybe their son or daughter doesn't want to take over the business you do. Become that. That person, help that person continue their legacy with you. Become the son or daughter that they never had. Those are just rules with your offer when you buy it. Now, number 4, finance it. So once you find the deal, you value the deal. Number 3, you know how to buy the deal. Number 4 is to finance that deal. Now, this is where people get stuck. They get stuck here because they're like, I have no idea how I would buy a business. I don't have all this millions and millions of dollars to buy this business. Let me give you a little secret that I learned about a decade ago. And that is that those who are buying these businesses very rarely, if ever, just are funding it with their own money. It's very rare. Not that it's ever, but it's very rare, if ever, that they're just bringing all their own money in and they're funding it 110% on their own. Very rare. There's partners. There's different key components that bring the funds together. So I'm going to give you the 3 most common. 4. Okay, the 4 most common. Number 1 is seller finance. A whole bunch of these mom and pop owners, these baby boomers who own these apartments, these people who once again are old, sick, dying, etc., they would love to seller finance. They still want a stream of income coming in. They just don't want to do the operations of the business. Now, they're usually not going to do a seller finance for the full amount. Not that that's impossible, but it's very rare. Typically, it's anywhere from 30 to 50% of the purchase price over the span of about 3 to 5 years. So here's what I want you to think of, okay? I want you to think of how are you going to piece these 4 things that I'm talking about, how are you going to piece them together? How much do you need to negotiate for seller finance? Well, how do you know that? You need to know these other 3 that I have before you go to the seller finance route. How much of these other 3 that we can tap into can you really tap into, and how much seller financing do you need to actually bridge the gap, if any? Now, seller financing is very attractive. It could be a great fit on both sides. Now, number 2 is bank financing. These loans that we get, these deals that we do, they're called non-recourse loans. The 1% of the 1%, they are not signing their own personal liability for the loan. It's a non-recourse loan, which means it's backed by the cash-producing asset, the property. Now, that non-recourse loan is typically going to be around, if the funds needed, anywhere from, say, 60 to 80% of the funds. 60 to 80% of the funds come from a non-recourse bank financing route. Now, to qualify for that, once again, you need to buy a cash-producing asset that the bank says, yes, this is something that we'd like to buy and is in line with their criteria, and they'll give you that criteria. But also, you need to have experience owning, operating, controlling, something like that. Now, that's in the apartment space. In the business space, if you're buying it, they're probably going to want some experience under to you as well if they're going to lend to you. So what you can do is you can bring on a partner, or what we call it a sponsor, or what we call a guarantor. And that sponsor has the net worth, has the liquidity, has the experience to sign on the loan, and now you've become partners on this deal together. I am a sponsor on multifamily deals, but how did I get into the multifamily space to build the portfolio that I had? I brought other sponsors in, partnered with them until I had the experience owning, operating, controlling enough of these apartment deals that I could become my own guarantor and signer on these loans. So number 1, seller financing, 30 to 50%. Bank financing, they usually come in, once again, non-recourse loans, 60 to 80%. That's the bulk of the funds you need. Number 3 is friends and family. Friends and family. Most of these businesses and or these apartment buildings, the equity that's needed to come in to bridge the gap comes from friends and family. Now, your friends and family, once again, let them know what you're doing. Let them know what you're buying. Talk about what you're doing. Now, how you structure that, you're typically going to offer what's called a preferred return. A preferred return just means that they get paid first. They get a chunk of the profits before you get your chunk of the profits, which is Very, very fair because you're running and operating the business. And as long as you run and operate it properly, then and you get them their first chunk first, their preferred return, enough will flow down to you as well, which once again comes back in to what I said earlier. You need to know, is there enough margins for it to funnel down to the bottom line to you? So a preferred return of typically 6 to 8% plus upside on the back end when you exit. Now, another way to structure is that you can structure with no upside on the back end. You just pay them a flat preferred return with no equity upside. Now, if you did that, your preferred return would typically be in the 10% range. 10% range, but no upside on the back end. So if you're super confident in the deal and you know that there's going to be big upside on the back end, maybe it makes sense for you to do that. And maybe what they're looking for is they just want stabilized return. They want more cash flow than they're not really, interested in the upside, or the cash flow is more attractive to them than the potential of an equity upside. That could be a great structure as well. Now, a reminder for you is that the best time to raise capital is when you don't need it. In other words, you can start having those conversations right now. Right now. People can smell desperation. If you all of a sudden have an opportunity brought in front of you, an apartment building, a business brought in front of you, and you've never had any conversations with anybody, letting them know what you're looking for and how you're doing it, you're going to have a very, very, very hard time raising capital because nobody knows what you're doing. And the only time that they do know is when you come to them desperate about what you're doing. So start having those conversations now. Listen, a great question, a leading question you can ask, okay, is if I found an opportunity, and you spell out what that opportunity means, that gets you X percent, this is what I'm buying, this is the returns we're looking for. If I found that opportunity, would you be interested in me bringing it to you to invest in? That is the easiest way for them to say yes. And you want an affirmative yes in the beginning. And the more yeses that you can stack before you bring them the opportunity. See, Alex Hormozy says, the longer you delay the ask, the bigger the ask can be. So if you're having more and more and more conversations with these individuals before actually bringing them the opportunity, the more they are willing to invest in the opportunity. So start having those conversations right now. Let them know what you're buying. Let them know what the returns you're targeting. Let them know, once again, how you find it, how you value it, how you buy it, and then where they come in and are able to partner on that. And then when you bring it to them, well, they already expect you to bring it to them. You're not shocking them. They've already said, yes, please bring me this. And when you bring them something that is getting them the returns that they desire, well, then you'll get what you need. Remember, we get what we want by helping others get what they need. What do they need? How do you get it to them? That's the key for both sourcing the deal and sourcing the capital to buy that deal. Now, number 4 is you. You can bring in funds. Number 4 is you. Say that you do have some capital that you can bring into the deals. You should absolutely bring that into the deal. It's going to be easier for you to raise it from friends and family, to bring it in from the banks, and easier for the owner to give you seller financing. Think about those real quick. If you know how much money you can bring in, you've had that conversation with yourself. You've had conversations with others, friends and family, and you know how much you can raise. You have an understanding of how much the bank will lend based on the type of asset that you buy. Well, now you understand, do you need seller financing to bridge the gap or not? See, the more options, the better, but you need to be clear on not only what you buy, but how you're going to bring the capital in. The key that you need to understand is it doesn't always need to be your very own capital, all of it. It's very rare that that's the case. Now, number 5 is once you find the deal, you value the deal, you buy the deal, you finance the deal. Number 5 is you own the deal. So number 5 is to operate that business. So I'm going to give you the 5 necessities for you to run the business. 5 necessities. If you are a business owner of any kind, these are 5 things that you need to have in place for you to make sure that you run that business efficiently and effectively. Number 1 is outcomes. Outcomes and priorities. Okay. When you understand your outcomes and your priorities, you're going to understand where you can resource or you can allocate your resources. So your outcomes, your priorities, well, your priorities need to be aligned with your outcomes, which means then you'll know how to allocate your resources. So what are the priorities to allocate time and money to is essentially the question. What are the priorities to allocate time and money to? And the only way you know that is what outcome you're pursuing. What is the outcome? What is the number one outcome that you're pursuing? And then you need to make sure that you're putting your priorities in line with that. Now, the reality is this. If you're starting a business right out the gates, your number one priority is going to be to bring in buyers, bring in customers. There's really 3 stages of business. Okay, you can write this down too. 3 stages of business. Stage 1 is to promote, to, well, get feedback, meaning you're getting buyers. You're promoting, you're bringing buyers in, and you're gaining feedback from them. You built your product, you have your product, great, but they're going to give you feedback on that product to let you know what changes need to be made. I promise you, your changes, there's going to be changes that need to be made. Step 2 is then to improve the product. So improve the value that you provide. So solve problems until there's no more problems to solve. Make it so the value that they get is, man, it's off the charts. And then number 3 is to scale. See, if you try to scale before truly having something that people are going to want to continue to buy from you, you'll have problems with your business. You'll have to continue to create new revenue streams. How does that come into your apartment buildings? Well, step 1, when you go in to buy a new apartment building or your business, is very rarely to raise the prices. To raise the prices of the product, to raise the rents on the product. It's very rare. You're going to go in, you're going to figure out what problems do you need to solve for those tenants, for those buyers, for your clients, and you're going to put allocate time and money to that, which will then help you understand, or then put you in a position to raise prices, raise rents, raise occupancy on your apartment building, all those kind of things. So what are the biggest outcomes, and then how do you prioritize those outcomes? Number 2 is execution, follow through. Listen, you need results and identify what those results are, and then you need to measure those things. So you need execution, follow through, and results, and that all comes from measuring. You need to measure. You can't manage what you don't measure. So what are you doing, and what is working? So who is doing what, and is it working? So what are you doing? Is it working? Who is doing what, and is it working? And then remembering that it's not about just hard work. It's about the results. See, I will list out what is the outcome that we're looking for, the measurement that we're looking for. Why is that measurement the most important? How do we get there? Let's say I list out 10 things that we can do, I can do, the person can do to execute and get the result. But the reality is that if I only need to do 3 of those things to get the result, I'm going to do those 3 things to get the result. It's not about working hard, it's about getting the result. But the key is you need to understand, once again, number 1, what is the outcome that you're looking for? And then number 2, this really comes around execution. How do you actually execute to get the outcome? Number 3 thing that you need on your apartments, in your business, within anything you do, is you need to have improvement and growth standards. Meaning, where are you looking to improve? What are those most important measurables, those KPIs, and where are the trends that you're looking to take those? What are the most important measurables, and where are you looking to take those? In other words, what's the level of performance you expect? The base level is your KPI, and now where are we growing those things to? For example, in my seminar business, my event business, one of the most important metrics is a show-up rate, okay? It's the show-up rate to the event. If we can have the best marketing to get people registered for the event, but if nobody shows up to the event, well, my goodness, the event's a flop. We need people there. Now, the other one is, so that show-up rate, once again, typically ranges right around 15 to 20%. Where do I want to take that? To 25, 30%. So what do? We put things in place to incentivize the team to be hyper-focused on getting those things up, those show rates up, which will take our cost of acquisition down, right? Which takes our profitability up. The other side of that is lifetime value. Lifetime value comes from the value of the product that you have, and the more people continue to re-engage with the product. Okay, there's ultimately 3 ways to grow your business, okay? You can write these things down as well. More clients is number 1, obviously. You need more clients. Number 2 is you need more revenue from those clients, meaning that they pay you more for it. So meaning raising prices, something like that. Think of it this way. You go to Starbucks and you have a grande, I think it's like a tall, a grande, a venti, and now there's a super venti. So how can you give them more value with very little input on what you need from you? The input you need to put is very little, but the output that they're willing to spend for the value is more. That's what you're looking at. Okay. So what are those things? Where are you looking to grow your business? And then number 3 is repeat buyers. So whether they're either referring you a buyer or they're buying more things from you. So number 1, more clients. Number 2, the value goes up on what you charge for those clients. And then number 3 is how often they buy from you or refer somebody to you. That's how you grow. But what are your standards? What are you looking to get to? Now, number 4. So remember, number 1 is outcomes. So you know where to allocate your resources. Number 2 is execution. You need to measure. You cannot manage what you don't measure. So you need to measure so that your team knows how to execute. Number 3 is improvement, growth standards. What do you measure and how are you, what's the level of performance you expect and where do you want them to take it? Number 4 is culture. Culture will trump strategy all day. What is the culture within your business? What is the culture within the property that you have? What is it? How do you treat each other? How accountable are you? Like, if somebody doesn't hit that performance metric that you set, can you keep them accountable? Are they going to be angry if you keep them accountable? Or are they grateful that you kept them accountable? Because they have, a personal standard of growth and results and all those kind of things. What's your culture? Do you plan together? Are you grateful? Are you nice? Are you fair? What is it? What is your culture? You need to have that in any business. It's a massive part of anything that you do on a property level, at your business level, whatever it is. And then number 5 is you need to pursue reality. Okay? You need to pursue reality. You need to have realistic goals. My tagline is think bigger. Okay? I love thinking bigger. I love taking to a whole nother level. I love that kind of stuff. But you also need realistic goals, realistic measurements. Okay? You also need to say what needs to be said. Say what needs to be said. Don't try to sugarcoat things. Don't try to kid glove it. Say what needs to be said. Once again, how do you keep a good, strong culture? You set realistic goals. You say what needs to be said. Number 3, you create accountability. Accountability is powerful, man. Are they accountable to the, once again, metric that you've set? Number 4, you need to be able to make tough and unpopular decisions. You cannot tolerate mediocrity. You cannot tolerate it. Your business is not a family. It's a business. It's a team. You're on the team if you produce results. If you don't produce the results, you're not on your team. It's not because you're a bad person. You're just bad for business. See, if we're truly going to provide a valuable product to our client, we need to produce results for the client. So you need to be able to make tough and unpopular decisions. Because I'll tell you right now that if you are trying to get everyone to like you, you are not a leader. A leader by default isn't going to have everyone like them. They're not going to make all the popular decisions. They're making the tough decisions that other people don't want to make. That is leadership. By the way, what I just mentioned is leadership. Make tough, unpopular decisions. Create accountability, measurements, so that people know what you expect and how to hit it. Tell them what needs to be said. Give them feedback and give them realistic goals to hit. That's leadership. Now, those are the 5 moving parts of any business. That's the 5 things you need to understand if you're going to buy a business, buy an apartment. You need to answer those questions and figure those things out for you to truly be able to find, value, buy, finance, and operate that business. So, as hopefully you found some value from this, and I know you did. So first, before I give you your next steps, go share this episode with somebody else. If you found value from this, go share this episode with somebody else. Leave us a comment and let me know what was the biggest takeaway that you had. Leave a comment on telling me what you're going to go focus on your business. Maybe it's not all 5 of the things you needed to know. Maybe it's a little piece within one of the steps that you needed to know and then go master and improve. What is it? Go share it. Now, your next steps, your actionables here, okay? Develop your rules, man. Number 1, develop your rules. Like, rules keep you safe, but it also makes you way more confident to know what you're going to be pulling the trigger on. When the target is clear, success is near. What do you buy? Why do you buy it? Develop your rules. Number 2 is to start researching. Start researching. Start looking at deals. Start looking at lots of deals. Start figuring out and researching what do you want to buy and why do you want to buy it. Number 3 is spread the word. Once again, quit keeping this stuff to yourself. People will give me a business card and tell me that this is the business that they run. I look them up on social media. There's nothing that they've ever even posted on social media about the business that they run. Your business card I throw away in 1 second. But your social media, we connect on social media. Well, I'm going to continue to engage with you for a long time. So if you are not putting an effort on social media to let people know what you do, listen, you're not going to find your daughter, right? Remember that example. If you want to find your daughter, if you want to find your business, if you want to actually do what it is you say you want to do, tell people what you're doing. Now, number 4 is to start dating. Start dating. Look at tons of deals. Once again, you don't know if the deal is attractive or unattractive, if the girl or person is attractive or unattractive, if you've only seen one deal, one person. Look at a lot of people. Look at a lot of deals. Figure out what is attractive and unattractive to you. And then number 5 is start your financing. Meaning, start figuring out where you're going to bring in the financing. How much money do you have to put into your business? How much money can you raise from friends and family? How much money will the banks, lenders bring in? And then once again, can you bridge the gap with some seller financing? My friends, the epitome of owning the outcome is this kind of stuff. If you want to run a business, you need to know what it takes to run a business, and those are the 5 moving parts of any business. Now you need to own the outcome of your business and your future by determining which of those do you need to focus on to grow and scale your business. Cannot wait to hear about it. Cannot wait to hear what you've implemented and the success that you've seen and continue to see. You just know that we're cheering for you over here. So, as always, go share, go leave a comment, and live always with aloha. Peace.